Tenant buyer financing. In ALP system, the main objective when entering into any deal is to make sure that the calculations for tenant buyer financing are done accurately. Number one thing, the down payment should be sufficient so that when the time comes, the tenant buyer is able to qualify to purchase the property. Number two, that they are able to afford throughout the term. And that's very, very important that in the end that they should have sufficient money to close the deal. So let's discuss about this, how tenants buyer financing should be arranged and how it can affect. In this section, we'll talk about the financials you need to consider when dealing with the tenant buyer. I'm talking about the financials at the start of the transaction, throughout the deal's term, and the financials required to close the deal. This is not to be confused with how you make money with the lease options. We'll examine the critical choices throughout the section you have to make regarding all the financial related to the lease option. How are you going to treat all of that money? How much money are you going to collect from the tenant? And how are you going to apply for those funds, and how will you approve the tenant based on financing that they have to get at the end of the deal. The first financial component is the upfront deposit. When you inspect the deposit, you should consider the following factors. First of all, is it a deposit or an option credit or an option consideration or a down payment? All these terms mean the same thing. However, you also need to know how the banks would view these deals. There are few issues that you might run into depending on how you treat the upfront deposit. The following financial components happen throughout the length of the lease option arrangement. These financial items are monthly credits or monthly profits. Profit is not a tenant consideration even though the tenant is paying you the profit. During the term of the lease option program, the ALP program, there is an amount that you might have added to the monthly payments, which is called the additional payment. That may be credited towards the purchase should the tenant decide to buy. When considering adding this credit to the tenant's lease payment, you should make sure that is this something that the tenants can afford. You want to make sure that the total amount is not so high that the tenant will be moving out in 6 months because they can't keep up with that paying that amount. The base monthly payment is to cover all the housing expenses. There's also credit component that will be added to the crediting the tenant when they purchase the property. And finally, the other monthly piece is the profit. The monthly profit is an additional amount that you add to provide a reasonable overall profit for the deal, and you may want to add this to the monthly profit because end price is due to the low appreciation in that area. The third financial component that you want to add to be concerned is the down payment the tenant has to save. It's all about that certain amount the tenant has to be ready to purchase the property or to qualify for a mortgage to purchase the property. At this point, they buy it for an already agreed upon a price, depending on which formula you use in the ALP system. They will be using the initial deposit and the monthly credit as the down payment, plus the additional rent that we collect and the boosted saving plan in the ALP system. The monthly deposit, the monthly down payment, you might be helping the tenant save, let's say 5% of the purchase price or 10% of the purchase price. However, you might want to consider helping them save maybe 10 or 15%. The additional savings will allow them some money for the closing costs, and this could be anywhere from 2, 3 or 4% of the purchase price, depending on where you are closing it, and what's the overall purchase price of the property. You want to make sure that all contracts are structured in such that when the tenant goes to purchase the property, they have enough money available to complete the transaction. You will have to help the tenant out with that planning and preparation and accumulate the down payment for the eventual purchase and closing. The first tenant's financial item that you need to be concerned is the deposit. The deposit, or the option consideration as it's sometimes referred to, is the amount of money that the tenant will put down to be able to move into a particular property. The option consideration gives the tenant the right to purchase the property at some time in the future upon an agreed upon or price. For example, if we have a property worth of $300,000 and the future price is $330,000 and the down payment is 5%, and which can be of the end purchase price or the current purchase price, which is it can be $15,000 or $16,500, depending on how you agree with the tenant buyer, because the more the deposit the tenant buyer puts down, the easier it is going to be for him to accumulate enough down payment to purchase the property. The initial deposit that they pay, let's say $10,000, would go to the down payment for the eventual purchase of that house. Some people think that if they have 5% to put down, they wouldn't need. Sometimes they don't, but majority of the times they do need, as the banks are getting strict and strict with the qualifications of for a mortgage. There are a few things to consider when determining the amount of deposit or option fee. The first thing is the income of the tenant. The second thing is your comfort level and the risk associated with the tenant. The third thing is the purchase price or the price of the house. If the tenant is only making $20,000 a year and trying to purchase a $300,000 property, and they want to put $2,000 down, that's not going to work. The minimum deposit in my area is $20,000, but depending on the area you are in, you might accept even $10,000. But sometimes there are exceptions. For example, I may allow a minor warranty depending on the person's credit capability, income. I would then set up a payment plan to collect the balance. I have one gentleman right now, his credit score is 720, which is an excellent credit score. He has two incomes. He's an employee and has a side business as well. However, the bank won't recognize his side business. 99% of the banks do not recognize the side hustle that they're doing because it's not a full-time job. It's not a fully declared job. And a lot of the self-employed do not declare the extra income that they're making. Even if they do declare, it's not properly documented. But through the due diligence that we have done, we know that he makes twice as much as what the bank think he makes. And that's what we did is that we have a lease option arrangement where he's paying $2,000 a month as the option fee payment, and he only has a small deposit to pay for $2,000. We are collecting another $1,000 every month to his deposit. So because income, he has negotiated a lower deposit. I normally would not do such deal, but because of his exceptional credit and we like him as a person and we see that he's a good person that needs to be helped. So we want to make sure what kind of people they are in and what situation are they in and why are they in that situation. We want a minimum deposit of $20,000. You might be living in the area where the house prices are down or lower. At least you should accept 3%, minimum 3%, which should be a minimum deposit of $10,000. Unless you have exceptions, as just like I mentioned, but the deposit amount could depend on the price of the house. For example, another deal that I'm doing is that I have a property that we already paid $500,000. This is an expensive lease agreement in the area. I asked him to put a $20,000 down payment, but between him and his wife, they make $200,000 a year, so they have the income to support it. But the same time, I have been very concerned that he doesn't have enough equity or enough skin in the game. And if he misses the payment, I will have to find a way to let him go, because I don't find that he is committed unless he's putting enough down payment. So we are now coming to close our deal. I don't think his credit score is still good enough to qualify, although we have tried to improve his credit score. Not every client will follow your credit instructions, so you want to make sure you follow up properly. I'm concerned that he may walk away from the agreement since he has only $20,000 in the deal. Now, he does have another maybe $26,000 in credits, means overall $26,000 in credit that he's accumulated over a few years. But I'm still concerned due to high-end homes. And I have probably been asking maybe 30 or 40 even deposit or 25 deposit. Some investors use a rule of thumb, and I normally do that too, is that the deposit amount should be a minimum of 5%. Now, to qualify for a mortgage, the lender look at the applicant's income, down payment that they have, and their credit score, and how long they've been employed. There are a lot of points, and whether they have any collections or whether how their performance has been overall. So it's not just the down payment that they have. Make sure you explain that to your prospective client and the tenant buyer. One important point is to make sure that it's better to have it empty than to have a bad tenant. If you put somebody in a property, they have given you, let's say, $1,000 deposit or even worse, $500, and they are paying $500 a month to accumulate the down payment. There's not enough skin in the game, so to speak. My experience has been that most of those people are a terrible risk. A small deposit doesn't give the tenant a lot of skin in the game. This often makes the tenant a big risk, and I would not do such a deal. So make sure when you are doing the deals, you are not desperate for the deals. They are always good enough clients that will come. It's just a matter of searching and finding the right one. And so one important point is make sure it's better to have an empty unit than a bad tenant. When I first started my lease option business, I had many tenant buyer defaults on me because I allowed them to enter into an agreement where the deposit wasn't high enough. And again, the minimum deposit may be lower depending on the area. However, in one city where I invest the purchase price was around $200,000. I might have a minimum deposit of, let's say, $5,000 in those days. And these other towns and my houses were worth $300,000, where I would put a minimum requirement of $20,000. So it all depends on where you are dealing with, what type of property is it, how much is the down payment, and what kind of people there are. You want to get them to commit the higher the deposit, the possible, because the more skin they have in the game, the better they're going to behave, the more they're going to take care of your property, and the higher are the chances for them to purchase back the property. Now let's look at the tenant's monthly payment. The next tenant's financial component is that we look at the monthly payment. The monthly payment is the lease payment that the tenant has to pay monthly. When settling or setting up the lease payment, you have to make sure that it covers all of your expenses and all of the things, the monthly costs. The first thing you want to ensure is the monthly payment covers your monthly costs. The monthly costs may include your mortgage, principal, mortgage interest, taxes, and insurance, which we call PITI, PD. And those are all the typical costs associated with it. There might be other costs like cutting of the grass, or if there's an extra bigger yard, but majority of the way is arranged in such a way that the tenant is responsible for taking care of the property or minor maintenances. At the minimum, the monthly lease payment that the tenant is paying should cover the costs and give you some profit. Instead of, you never want a deal where you're putting money out of pocket. You never want to have a negative cash flow when doing these deals. I have heard some investors that they can't afford and can't find any good deal, and so they're okay with a negative cash flow, and they will make it up in the back when they sell. That's a totally wrong approach. That's not real estate investing. And there are all kinds of ways you can make sure that you got positive cash flow, as we have discussed in our trainings. So you want to make sure each property has a good positive cash flow, because at the end of the day, it's business and it's a real estate investment, and you want to make sure you're making money and you're investing it right. Now let's look at the monthly credit. This is the second component that makes the monthly payment in which there's a monthly credit. The monthly credit is the amount that you add to the monthly payment that will eventually go to as down payment, which will be added to or credited to the down payment when the tenant buyer buys. This is kind of forced saving for the tenant buyer. We also call it the additional rent. Okay, so it depends on how you phrase it, but in ALP system, we calculate as the additional rent, and you want to make sure that the tenant buyer agrees to it and can easily afford those additional payments, and show them the calculations why you are adding that amount and what it will help and how much it will help them save. So let's say, for example, the tenant buyer needs a down payment of $20,000 to purchase the house. They give you a $10,000 deposit, which means that they need another $10,000. And this could require an additional payment of $300 spread over 36 months. And if they use a 3-year contract, for example, for you, the best would be to increase the monthly payment by $300, and cumulative credit will be applied to the down payment when they purchase the property. Never allow the tenant to save this money on their own and not pay you the monthly credits. First of all, you want to make sure that the monthly credit or the credit amount is delivered to you, since it's also providing you the extra cash flow. Secondly, the tenant may not have a habit of saving, and if the tenant hasn't been able to save enough down payment till now, what are the chances that they will save on their own? So you don't want to leave it up to them to save the balance. You want to make sure the money is there when it comes, let's say in 3 years or before 3 years, to close the deals. So make sure that they want and they are able to save the down payment and the initial deposit. And now they are paying the higher monthly lease payment and all the other expenses. It will be more difficult for them to save. To cover all expenses, it's essential to increase a budget as much as possible before completing the fiscal year. When it comes time to buy the property, make sure they have collected everything, they have enough down payment to purchase. The third component of the monthly payment is the profit. Some people think that you cannot add anything to the monthly payment other than that what is required to cover your costs. Sure, you can. You are trying to make a good return on your investment, and some investors are charging a lot of profit where it's outrageous. I'm not suggesting that you do that. Your overall profit is based on the eventual sale of the property, and the sale price can be found in the estimated appreciation. But it may be that you are concerned that where the economy is and the total cost of the lease multiplied by the number of months the property is in the lease term to arrive at the net present value. One thing you can do is to reduce the sale price and increase the monthly payments. So this will allow you to make the profits that you want to make while keeping the back-end sale price within reason. For example, you can add $200 to $300 or $400 as your monthly profit and decrease the eventual sale price. So this, what it does is, instead of making profit in the back end, you're making profit in the front end. So this works very good. The reason for that is, provided the client has the cash flow, provided they have good enough income. This provides you with the additional cash flow and give you the additional income to qualify for more properties, because it adds to the overall income from the property. If you decide that you will increase the monthly payment this way and decrease the final purchase price, you want to make sure that the tenant can afford the higher monthly payments. It would help if you have evaluated the tenant's traditional bank's evaluation process or their income statements and all that. When evaluating a tenant's financial capability, I use the standard GDS, which is gross debt service, and the total debt ratios, which is TDS, the total debt service ratios. So we'll discuss that in the further slides. When using the GDS, I don't allow their full house payments to exceed more than 32% of their gross income. So if the lease payment is $2,000 a month, they should approximate $6,000 a month or $72,000 a year. And that's the minimum income they need to be earning. I also look at the TDS and want to approve anything where the TDS is higher than 40%. So if their car payments, credit card payments, or the total payments, and an additional $1,500 or totaling $1,500, and their lease payment is $2,000, that would make their monthly payment as $3,500, which means they will require the minimum income of $8,750 per month or $105,000 per year, because $105,000 times 40% divided by 12. So you want to make sure that they don't exceed, the TDS does not exceed 40%. And majority of the mortgage brokers or mortgage lenders or the banks or financial institute would use similar qualifying criteria of the GDS and TDS. So you want to make sure you keep it within those limits. These are similar to the bank limits, a little bit more stringent than the bank limits, because you want to be 100% sure that they qualify for a mortgage when the time comes. Now let's look at the tenant down payment. The last financial component that you need to be concerned is the tenant's down payment. I've been referring to here is the upfront deposit, but rather the down payment that the tenant actually needs for the eventual purchase of the house. The key to the down payment is that you have to make sure that tenant has accumulated large enough down payment to purchase the property, not only just enough down payment just to buy the house, or just like, for example, 20% or 10%, whatever they needed to qualify, but also the closing costs. You want that everything is there, so when it comes time to purchase the property and there are no hiccups. The down payment is calculated based on the purchase price. That means if the purchase price is $300,000 and then there's a 10% discount, so the total cost is $280,000, and tenant is accumulated, let's say 5% down payment, which is $15,000. Assuming that they gave you upfront $10,000 and now they have to collect another $5,000 over the length of the contract. This down payment that the tenant is saving is the down payment that they will use to purchase the property. Of course, you have to add to this your yearly appreciations, which are added in our ALP contract. You want to make sure that the end purchase price, that they have sufficient down payment based on the end purchase price. Sometimes they think that these accumulation of the deposits and credits are refundable. So they believe that they will get the money even if they don't buy the property. You want to emphasize that very clearly, make it clear to them that this is the option money and this is that you're giving them a credit only if they purchase the property. And that credit money will be only given to them if they purchase the property. If they do not purchase the property, they don't get any money back, because your objective is you bought the property and you've been holding it for a few years for them to purchase it from you. So they have paid you a consideration fee for allowing them that. The amount of money that the tenant contributed to their down payment through the initial deposit or monthly credit is not refundable. Make sure they know it and they sign it off, and ensure that there's a waiver or statement to sign that upfront, and it's clearly written in bold terms and bold words and the initial next to it, stating that it's non-refundable. Your tenants may decide that they are not going to purchase the property. By doing so, they walk away and waive their right to the initial deposit and monthly credit and boosted saving bonuses, etc., and the additional rent. For example, I have a couple that put a $20,000 down and moved into the property. After a few months, they decided they didn't want to go ahead with the property to purchase the property. They left. They didn't notify me. And they tried to get back their deposit by hitting back with the lawyers to come back on us, but they lost since the contracts were clear that the deposit is non-refundable. The down payment that the tenants are accumulated has to be the amount that the bank will accept. For example, I mentioned 5% is the amount that the bank would require, and maybe they are self-employed and perhaps the bank you are dealing with will require them to either put a 10 or 20% down for the self-employed individual. You have to consider all of this when determining how much the down payment the tenant has to save. You look at the kind of job. You should consult with your mortgage broker in your team and your power team, so that they understand how much the end down payment they will be needing and what will be the down payment criteria, and will they qualify if they have enough down payment. And where it's harder for people to qualify for a mortgage if they're self-employed. So you want to take all those things into consideration. You want to also consider that you may wish the tenant receive the additional money for the closing costs. The closing costs can be as high as 2%, because 1% is normally the land transfer tax. But if you're living in Toronto or some city other than like that, there might be a 2% land transfer tax or property tax. So I want to make sure that you want the tenant to save few percent, at least 5 to 7%. 2% can be used for closing costs, 5% at least for the down payment if they're employed and they have good enough credit score, or you might want to save 10 or 15 or 20% depending on the particular situation and their income and overall situation. Remember, you have to make sure that you evaluate the tenant's credit along the way using the good credit management program that we have put, and you want to make sure that they are ready to purchase the property when they need to purchase the house. And you want to also keep good records of the deposit and the credits that they have paid. For example, the tenant writes you a check for $10,000 deposit. Make sure they keep a statement and you keep a statement, and that the banks and they get the bank statement that shows a review of the $10,000 that they gave you as the deposit. Please take a picture of the check, keep it in the file. Make sure you keep a track record of the monthly payments. There's a straightforward way to show the lender that down payment has been collected from the tenant. So it's all about putting everything together in such a way so that it's easy for the bank to understand that it is their down payment.